The S&P 500 fell for the fourth straight day, something it hasn't done in a couple of months, yet we remain with a bullish posture as we're still above that rising 30-day moving average. We also had a little bit of a strange occurrence in that interest rates did fall here today, but we saw the financial sector outperform to the upside and real estate underperform to the downside. Usually that is reversed. So we'll take a look at all of that and see what it means for our posture. Then we'll get into our trade application example where I wanted to feature a neutral trade on a commodity ETF with an iron condor. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's September 9th, 2021. First of all, for those of you that are new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below and make sure you're signed up for our email distribution list. We're also heavy users of Twitter. Feel free to follow me at Brandon Van Zee if you're not doing so already, and we really appreciate those of you that click like and retweet on our Market Outlook related tweets. And then last but not least, we do have a presence over on Facebook. Feel free to join our group at that web address embedded in the logo in front of you. All right, with that, let's go ahead and jump into today's trade activity. As you can see here, the S&P 500 did sell off today by about 0.46%. Believe it or not, it was an above average sized range day. You can see we moved about 37 points today. Typical average true range recently has been around 28. It's a little bit more of aggressive movement, but in the end, it was not disastrous. I think it's more of a reflection of how quiet trading has become here in recent months more than anything else. But as I mentioned in the intro, despite having fallen for the fourth straight day, which matches what we saw back here for the for 4 days in a row back from looks like it was June 15th through June 18th, we continue to have a bullish intermediate posture. Notice that the green line is still in the upper reversal zone above 80 on the market forecast. So remember, whether it's rising or falling, as long as it remains above 80, we do consider that to be strongly bullish. And you should be able to determine why that's the case when you look at the chart. Yes, we've had 4 sell-off days, but that is still an uptrend that's in place. We start in the lower left and we're ending in the upper right. And we've had a couple of those pullbacks along the way. We had one back here in kind of mid-June. In fact, a few days after that 4-day sell-off, we did go to a bearish posture for just a couple of days, but fortunately we had a pretty solid rebound during that time period to quickly revert that posture back to bullish. We then had another kind of sell-off here in the middle of July where we had 4 out of 5 days to the downside. We did have that day right there being a bullish day. But anyway, after that sell-off, we again went to a bearish posture, but just for a brief amount of time. In both cases, we stabilized right around that 30-day moving average and used it as a launch pad up and off. And then as we coasted higher here, we again came into a little bit of a stumbling block. Now note that this stumbling block was preceded by a couple of these red dots showing up here on the chart. A reminder that those red dots are known as bearish cluster signals, or a better way to phrase that would be overbought cluster signals, and just gives us the impression that in all likelihood that trend is not likely to continue at the current pace, and one of the ways that gets resolved is by a reversion to the mean to the opposite side, and that's what we got here in these 2 sell-off days after those clusters formed. Well, once again, we kind of hung out here right at that moving average, and we bounced up and off of it. 3 really solid days up and off of that moving average. Now notice during that time, we didn't even move to a bearish posture. We didn't have a pink background color there like we did back here and back here. And so it'll be interesting to see how this one shakes out here. If I had to guess, I'm going to guess that we probably will go to a bearish posture on the S&P 500's intermediate line because we've got a pretty decent amount of momentum kind of spilling over there in that green line. And if it would fall below 80, it's at 85 and falling right now. If it were to fall below 80, that's where that posture would then change to weekly bearish. But even if that does occur, if we're still trading above the moving average, which I think is entirely a possibility here, I don't know if I would necessarily be getting too aggressively bearish there until I started to see more solid support breaks along the way. Right now, we continue to be in a trend of higher highs and higher lows, and yes, the last 4 days have not been all that kind to bulls. On the other hand, this is normal market behavior here, right? The markets don't go up every day. So, all in all, we've had a very successful 2021. So if this is part of the worst of what we have to put up with along the way, I'm all for it. So be on the lookout for a possible rebound if we do get down to that rising 30-day moving average, just like we did the last 3 times around. With the another thing I should point out with the S&P 500 and the Russell 2000, we did get what's known as bullish intermediate confirmation signals. However, neither one of them would be considered ideal for a couple of different reasons. In the case of the S&P 500, first of all, once again, just a quick explainer of or explanation of what a bullish intermediate confirmation signal is. First of all, it's a buy the dip signal. So what we're trying to identify is a stock, or in this case, an index that has a strongly bullish intermediate posture, right? So step one is identify an uptrending security, in other words, in layman's terms. We use that green line to help us identify that. If that green line is in the upper reversal zone, like it is right now, then it has a bullish posture. Remember, the green line could also be rising between 20 and 80 to have a bullish posture. But right now, what exists is just us simply being in the upper reversal zone. So we check that box there, and that's the same with the Russell 2000. Now note the Russell 2000 is even closer to falling into a weekly bearish intermediate posture because it's at 80.9 right now. Again, if it falls even to 79.99, that background color will change to light pink. So that could happen as soon as tomorrow for the Russell 2000. But as of this exact moment in time here on a Thursday night, we do have still the strongly bullish posture as it's in the upper reversal zone. So that exists on both of those charts. Also, what exists on both of those charts is the red momentum line in the lower reversal zone. Now there you can't just have the red line traveling between the upper reversal zone and the lower reversal zone. It actually has to be in the lower reversal zone in order to qualify for this signal. And so you can see that the momentum line here on the S&P 500 is at 2, in other words, easily below 20. And the same thing with the Russell 2000. Red line's in that lower reversal zone. It's at 12, easily below 20. But one way to, or there's a couple of ways to kind of try to determine whether the setups are more ideal or less ideal. And, those two different ways to approach that are good examples here tonight in this video because we see an example of each on each of these charts. So let's talk about it. What we'd like to see out of the blue line is for it to show up somewhere between 20 and 50. And you can see that is the case here on the S&P 500. The near-term blue line is at 22. In other words, it's between 20 and 50. However, we also want to make sure that the momentum line is not at an extreme reading. And what we identify as an extreme reading is below 5. So in this case, it's at 2.45. Obviously, that's below 5. So you can see it's way down here at the bottom. And that can sometimes start changing the sentiment around the chart to become more bearish in the future. If these are really big pushes to the downside where we're closing near the lows of the day session like we were today, then that can sometimes lead to maybe more cockroaches coming out later on. So it's just something that we want to be on the lookout for. It's not something that is necessarily going to scare us out of our bullish trades or anything along those lines, but it's just a way to kind of separate the wheat from the chaff in terms of what are the better setups versus what are the less good setups that are out there when it comes to the bullish intermediate confirmation signal. So in that case, we do have the red line is kind of giving us a little bit of a warning signal there. Again, I'm not gonna personally read too much into that because I still kind of like the way that the S&P 500 is trading here with these nice higher highs and higher lows that's being carved out. With the Russell 2000, that's not the issue. Notice that the red line is at 12. And so again, What we consider to be an extreme move lower is when the red line ends up below 5. So here we did enter the lower reversal zone to satisfy the bullish intermediate confirmation signal, but we didn't go too low. We were somewhere between 5 and 20. In this case, we're at 12. And so that aspect of it is fine. The area that is not ideal for us is that blue near-term line. And again, just a reminder that the blue near-term line isn't technically part of the bullish intermediate confirmation signal. We just use it as an additional data point to help us separate that wheat from the chaff. And so in this case, again, like I mentioned up here, whereas the S&P 500 did have its blue line between 20 and 50 on the day of the bullish intermediate confirmation signal, the Russell 2000 did not. Notice that the Russell 2000 has its blue near-term line at 13. In other words, it is also in the lower reversal zone, and it's also a sign that maybe the selling is kind of a precursor to further weakness going forward, and buying the dips may not be a successful endeavor. Now, unlike the S&P 500, I think you guys know my attitude towards the Russell 2000 as I've talked about it here the last few times I've done the video. In fact, we have a bearish trade on the Russell 2000 right now from this video, which is that bear call spread that I presented. So when I look at the Russell 2000 chart here, I'm not nearly as excited about its prospects at this moment in time as I am for the S&P 500. Now, of course, that can change. Each day provides more information. But as of right now, you can see that this is more of a sloppy, sideways type of a chart that we're dealing with here. It's shown some rather impressive resilience in the last couple of weeks, so I've got to give it credit where credit is due, but we still are just barely hanging out kind of in the middle of the last 3 months range here as it stands on the Russell 2000 right here. So, you know, if you're thinking about the idea of buying the dips on a strong chart, and that's what the bullish intermediate confirmation signal is trying to help you accomplish, well, yes, it's true that the intermediate posture on the Russell 2000 is strong, but when I look at that chart, I don't know if I would go as far as saying that's a strong chart. It's a sideways chart to me, whereas the S&P 500 is still a strong chart in my eyes, and therefore I'm more interested in whatever bullish intermediate confirmation signals get served up on that particular index. So kind of an interesting compare and contrast of the bullish intermediate confirmation signal here this evening and showing two different ways where the ideal setup does not exist, but two separate ways to help identify that with the Russell 2000 and the S&P 500 here today. Russell 2000, by the way, was down today, but it was barely down. It was only down 0.03%. So it actually was, you know, the quote-unquote leader of the market today. Even though it was down on a relative basis, it was the leader. In terms of the other two indices that we see on the chart here, you can see once again the blue chips struggled. The Dow Jones Industrial Average was down 0.43%, so very similar to what we saw with the S&P 500, but as you look at that chart, you can see some extreme differences versus the S&P 500. Here with the Dow Jones, you've already slashed through that moving average. In fact, the moving average has struggled so much that it's actually started drifting lower. Price is now below a falling moving average, which is why that moving average is red. The background color of the chart is also suggesting that we're a little bit more bearish. In this case, it's considered weakly bearish, but as soon as tomorrow, I would say that there is a high likelihood that we're going to move to strongly bearish on the Dow Jones Industrial Average, unless we have some sort of an epic update tomorrow. The reason I say that is we are basically sitting right above the chart's midpoint on the green line. So notice the label says it's at 50, 49, and falling. Remember, if that falls to 49.99 tomorrow, that background color of the chart will switch to this dark pink color that we see over here. So there's definitely been a lot more selling pressure there on the Dow Jones Industrial Average. Now, one of the more interesting elements of the chart is you can see that we did bottom out the last time on the Dow Jones back here on August 19th, and we still have not broken through that level of support yet. So maybe, just maybe, we can form a bit of a double bottom there, which will give us maybe a reason or an excuse to start rallying the blue chips into the fall. Now, again, with seasonality in the back of our mind, we recognize that September and October can sometimes be filled with ghouls and goblins, right? There's a lot more disastrous stock market crashes throughout history in those months than other months. And so that's always kind of in the back of traders and investors' minds. And so I'm not sure if this would be the month where we could get a really big rally out of the Dow Jones, but even just stabilizing around this level would set us up for more promising activity as we head into November and December later this year. So this will be a key make or break moment here, is whether the Dow will be able to hold this level where it was able to bounce from back on August 19th. So we'll all keep our eyes on that together. With the Nasdaq Composite, it was down today as well, but it kind of fell between the Dow and the Russell 2000 in terms of how aggressive the sell-off was. It was only down 0.25%, so not that big of a day. And remember, the Nasdaq had been outperforming anyway. Just 2 days ago, it hit an all-time high. So unlike the S&P 500 and the Dow, which have been down for 4 days in a row, the Nasdaq Composite has only been down for 2 days in a row. So of all of these charts that we're looking at here, it remains our leader. Notice that the intermediate number is 92. Remember, that number can only go to 100. It doesn't go above 100. So 92 is pretty strong. And compared to all of these others, we've got the S&P 500 at 85, we've got the Dow at 50, and we've got the Russell 2000 at 80. From an intermediate time perspective, we do still view the Nasdaq Composite as the leader of this market right now. And as I mentioned on Tuesday, part of that might be Apple is really helping the Nasdaq Composite along at this moment in time with their product announcement they have next week. They've kind of been outperforming some of the other more speculative areas, and with a lot of these market cap weighted indices, it kind of gives Apple an added edge in terms of impact at the end of the day. So anyway, you can see that the Nasdaq Composite nearly closed with a bullish intermediate confirmation signal, but it just couldn't quite get there. The problem was definitely not the green line, right? The green line is still in the upper reversal zone by a long shot. The problem was that the momentum line did not quite get below into that lower reversal zone. It ended at 21. Remember, the lower reversal zone is at 20. So we were awfully close on it. And if it would have happened at the end of the day, it actually would have been a nice setup, because the blue near-term line would have been between 50 and 20. So anyway, it's a shame that we just missed it there. Nonetheless, it's a possibility that maybe it exists tomorrow. So maybe we can find that out as we close down the week here tomorrow. But in general, just be aware that it looks like the Dow continues to be our laggard at this moment in time, and the Nasdaq Composite continues to be our leader. And in terms of the better looking charts out there, I would definitely put the S&P 500 and the Nasdaq charts as superior to what we're seeing out of the Russell 2000, which also shares the strongly bullish intermediate posture for today, but is highly likely to go to a weekly bearish posture as soon as tomorrow or early next week. In terms of the 3 green arrows chart now, you can see here that that is going to be chart 4D, and we have a bit of a mixed bag in terms of 3 green arrows here today. We've got the Nasdaq Composite with 3 green arrows. We've also got the Dow Jones Industrial Average with 3 red arrows, but we have the S&P 500 and Russell 2000 with a mix of green and red arrows. So we actually have all 3 possible conditions for this particular chart 4D right here that exist at this moment in time. So when the background color is green, like it is down here with the Nasdaq Composite, it suggests that we have 3 green arrows, which is telling us that 3 different technical indicators are more bullish at this moment in time, including the 30-day moving average, MACD histogram, and the stochastic. The opposite is true right now on the Dow Jones Industrial Average. And that's why the background color is pink there. We've got a red arrow on the moving average, red arrow on MACD, and red arrow on the stochastic, whereas those other 2 charts have a mix of green and red arrows, and that's why their background colors are white. With the S&P 500 that occurred yesterday, so it's a little bit more obvious to your eye because all of today's candle is in the white. But that also exists down here on the Russell 2000. It's just that the way that this stuff gets plotted, you only see about half of it there. So be aware that today the Russell 2000 did plot a red arrow on the MACD. So we now have 2 green arrows, 1 red arrow on the Russell 2000. And that MACD red arrow is just telling us that we've got a loss of momentum there. And that's not a surprise because like the S&P 500 and Dow Jones Industrial Average, this is our 4th straight down day there for the Russell 2000. So really it's only the Nasdaq that does not have 4 down days in a row. So, kind of interesting to see the differences in this particular chart setup here as well. Let's quickly go over to the internet. I always like to get a chance to say thank you to those of you that help support this particular project. Remember, this video is available for free and we do it on a volunteer basis. It ends up taking us about 3 hours of our time whenever we do all the research and do the recording and do the editing and send out the notification, all that kind of stuff. So it's a big part of our day that we do for free just out of goodwill. And we hope that you guys benefit out of those. In general, I'd like to see us get at least 100 likes whenever we do this video to make it worth our while, right? We don't want to be wasting your time. Hopefully you're not wasting ours. Let's kind of do this together, so to speak. You get benefit out of David and I's analysis, and we get the benefit out of your likes there on Twitter, which hopefully will put our information in front of a larger social circle than we'd be able to do on our own. So I generally am shooting for 100 likes. Didn't quite get there the last time around. Only 86 of you stepped up to the plate. So just a reminder that these are done on a volunteer basis. If I get to 100 likes, I'm going to make doing this video a priority. If I don't get to 100 likes, then I'm just going to ask myself, what else do I have going on that day? And, if I've got other more important things to do, whether it's other work projects or just going to the doctor or something along those lines, then I'm going to do that instead. So I always want to be upfront with you guys on that. And I think that I have been. I pretty much mention this every single time that I do the video, so it shouldn't be a shock. If at some point we just don't get a whole lot of activity and promotion out of these videos, I may not do them anymore going forward. So I always want to be upfront with you on that as well. If I ever make that announcement down the line, I don't want it to come out of left field or something along those lines. I want to make sure that you guys were well aware of that in advance, so that way we all kind of understand this together. So if you want to see these videos done on a daily basis here, every trading day, like they traditionally are, we ask one and only one simple thing out of you that only takes 5 seconds out of your day. Just simply click like for us there on Twitter. Thank you very much for those of you that do that every day. I know there's a core group of you that do that, and we really do appreciate that. Also, while we're over here, take a quick look at the factor selector that I posted here a couple of days ago. Notice that the momentum factor continues to lead this market, which is a positive sign for risk appetite. However, we did see the low volatility area pop up there another slight, or another ranking, I should say. And so that's kind of the opposite mindset. Low volatility traditionally does a little bit better when the market is a little bit confused or wants to hunker down, or sometimes there's interest rate sensitivity that's built into that, because there's a lot of utilities and REITs and consumer staples that are part of the low volatility factor there. So it's kind of a weird mismatch up on top of our factor selector this particular week. On the downside, we did see that same combination of value and dividend yield remaining kind of our laggards in the current marketplace. Also, a reminder that we taught our premium classes here today. David taught his portfolio management with ETFs class. I taught my question and answer session for my premium students. Some of the questions that I addressed were on AT&T and what to do with it, with its upcoming separation with its streaming service. Also had a review of Brady Corp, which of course not a very popular stock, but with tonight being the kickoff of NFL football season, Thursday night football with the Buccaneers and the Cowboys. Of course, Tom Brady comes to mind there as the quarterback of the Buccaneers, so it should be a great game tonight. But anyway, we did take a look at BRC, which is Brady Corp, as a potential dividend growth investment. We also took a look at Cloudflare and how it is giving us various signals on the stock selector tool. We also had a conversation about inflation and likely future inflation, and conversation about whether we should be looking at dividend yield or whether we should be looking at dividend growth rates to compare that to inflation, and how we start thinking about structuring our long-term portfolios. We also had a question about some of the market forecast patterns. We had a question about Hormel with an oversold cluster on the weekly candle, which of course is a dividend aristocrat company. And then we had a conversation about New York's recent announcement that they were going to end selling gas vehicle sales, and whether that might be a reason to get excited about electric utilities. So if you're interested in those conversations, feel free to check out that recording that is posted to our Trading Rooms calendar, again, assuming you are a premium member of Market Scholars. And then tomorrow, David will be teaching his very popular technical analysis class. So if you've ever wanted to be taught technical analysis by a chartered market technician, that's your opportunity to do so each and every Friday. So make sure you're checking that out tomorrow. All right, back on track now with some of our charts. Let's go ahead and do some 12 grid analysis, starting with chart 5A. This will be our asset class 12 grid. And as I mentioned in the intro, one of the more peculiar things that happened today was that interest rates fell today. As you can see down below here, TNX fell today, and it ended at, the 10-year Treasury yield ended at 1.29%. And usually when that happens, you see the REITs outperform and the financial sector underperform. But today was a little bit of an opposite day where that did not occur for whatever reason. So I found that to be a bit interesting today. But as it stands right now, do note that the TNX did go back to a weekly bearish posture. You can see that background color is now pink once again. Now, I don't know how aggressive I'd get with following that at the moment because we still are above a rising 30-day moving average. So I'd like to see that broken to the downside if I wanted to take a trade based off of that information. Right now, I think you're still kind of holding out some hope if you want to be long interest rates that there could be a bounce right at this moving average right here, just like it did about a week ago. So that'll be interesting to see how that resolves itself. Remember, the opposite tends to happen with the bond prices themselves, and the TLT chart over here does show us that. We actually saw long-term U.S. Treasuries up 1.21% today. That's a pretty big move for a boring asset class like government bonds. And so you can see that that candle was a pretty large size candle right there that did push us up and through that previously falling moving average. So we've kind of been, pushing up and down through that moving average for the last few weeks now. We just can't seem to get a strong idea as to where it's going to break. Is it going to break higher or is it going to break lower? A couple of days ago, if you'd asked me, I would have said it looks like it's going to start breaking lower, but today kind of changes that picture once again. So, TLT could be an interesting place to start thinking about doing an iron condor or some other neutral strategy there as well. You can see foreign bonds also had a pretty nice upward surge here today. Now, unlike U.S. government bonds, foreign bonds broke down in a pretty big way in the last couple of weeks. So despite a very solid rally today, they remain with a strongly bearish intermediate posture, and they're still clearly below that falling moving average. So U.S. government bonds do look better than foreign bonds at this moment in time. High yield bonds also were up today. So all three of those categories of bonds up today. And of the three charts, this is the only one that has the dark shade of green, telling us that this is a strongly bullish posture, not just a weekly bullish posture like we saw over here with government bonds. We did see the U.S. dollar slip a little bit here today. So we tried to break up and through that moving average yesterday, but it was rejected and pushed it back lower today. It remains with a strongly bearish posture, as you can see there. And then we did have all of our different stock areas up here, whether it's U.S., foreign developed, or foreign emerging, close in the red today. But the outperformer of the group was the developed foreign stocks. That was the one that I was mentioning 2 days ago that was breaking out to new highs that not a whole lot of people have been talking about. So there seems to be some strength there that even on the down days for the stock market, there's still relative outperformance here for EFA. In terms of any sector action here today, I did want to point out again that it was a little bit peculiar. We saw financials up today, despite the market being down, and we saw real estate down significantly. In fact, real estate was the worst performer here today, down over 2%. Now, those numbers all by themselves are not all that peculiar. We see plenty of days where financials are up and real estate is down. It's that information in combination with understanding that interest rates were down today that makes it peculiar. Usually it's the opposite. So I'm not sure if there's a good reason behind it. I haven't heard necessarily myself. Wasn't around for the full day today. But anyway, I did find that to be peculiar. Now, despite the 2% drop in real estate, notice that this is still a really strong chart here. So I don't know if you want to be going and throwing away all of your super strong real estate companies like your American Towers and the self-storage REITs like Extra Space Storage and CubeSmart and Public Storage and all those. There's still a lot of really strong trends there in some of those REITs despite today's pullback. So we'll keep our eye on it, but right now it's just kind of a give back from that really big move up and off the moving average for the REITs here a week or two ago. In terms of any other interesting activity out there, I should point out that the financials were one of just three sectors that finished higher today, the other two being energy, which was up 0.21% today, and then also materials, which is barely up. It was up 0.04% today. So just 3 out of our 11 sectors finishing higher today. And again, REITs were the worst performer on the day. Let's go ahead and get into our trade application example now. And for that, I'll just pull up chart 4A. And you might have seen the drawn items when I was doing my 12 grid for the asset classes a moment ago on ticker symbol GLD. I didn't bring it up at that time because I knew I would be bringing it up here during the trade application example. What we did for the trade application example today was an iron condor on GLD. GLD was up 0.44% here today, so it did outperform the stock market. But as you can see here, this has been largely a sideways trending security. It really hasn't had a lot of directional movement either way, either up or down. It was looking a little bit weaker earlier in the year, but it's actually had a pretty decent rebound from this low around 160 here on August 10th. And so where we stand right now is approximately in the middle of the 3-month range that we've had. And so when you see charts like that don't have a lot of directional activity, either up or down, then they could be setting up as interesting choices to sell iron condors on. Some of you might not be familiar with that term of iron condor, but it's an option strategy that allows you to make money if the stock effectively just doesn't do anything and it just goes sideways. What it's doing is it's actually combining 4 different strikes. 2 of them are call options, 2 of them are put options at different strike prices, and you're selling the more expensive contracts and you're buying the less expensive contracts. And what happens there is it creates a credit. So you receive money up front for placing a trade like this, and your hope is to hang on to as much of that credit that you received as possible. And how you do that is to have the stock, or in this case the ETF in question, effectively stay within your break-even range. And you can see I've drawn the blue horizontal lines on the chart here that will represent the break-even in the trade that I selected. And I did the October monthly contracts for those of you that were curious. And if you're a premium member, you'll get all the details in the Telegram app as far as what were the 4 different strikes I selected and what were the credits that I received, etc. But even if you're not a premium member, you can see the basics of the trade setup here with those break-even lines on the chart here in front of us. And you can see that with the exception of exactly 3 months ago when GLD was a little bit above the blue line for 3 days, we have basically been trading within those blue lines for all of the rest of the 3 months. So whether that happens for the future 30 plus days that I need to be in this trade until the October expirations is anybody's guess. But in general, if this stock, or in this case the ETF, has struggled to break out previously, then, all else being equal, it's likely going to continue to struggle to break out until there's a catalyst of some sort. And that could certainly happen. But remember, one of the benefits of selling an iron condor is it is a defined risk trade. You know what your worst case scenario is going into it. That's the whole point of buying the lower priced calls and puts as kind of your built-in hedge there. Doesn't mean that you have to make money on the trade. It just means that once they cross either direction to the upside or to the downside, your bought strikes, then you're kind of protected by those strikes that are part of your iron condor trade. So anyway, you can see here that we've got some conflicting signals with the green line pointing lower, falling out of the upper reversal zone, and we've got the blue and the red line pointing higher, coming out of the lower reversal zone. So they're kind of pinching, and maybe they'll mate in the middle somewhere. And if that's happening, basically on the chart, it is likely going to be a situation where the chart is just going sideways. So that would be the behavior that I would hope for after placing a trade like this. So as long as we stay within the same range that we've been in for the last 2.5 months, then this should be an iron condor that could end up making some money for those that put it on. All right, that's what I had for you here this evening. Hope you enjoyed the presentation. If you did, do me one simple favor. Just click like there for us on Twitter. That'll let us know that you want us to continue to do these free videos for you as often as possible. David should be back in the saddle with you tomorrow night, and then I'll plan on seeing you all next week. I hope you all have a great weekend. Of course, those of you that were affected by the terrible tragedy 20 years ago, we'll have you in our minds as well. I still remember being a young whippersnapper myself. I think I was like 22 years old, and I was working in downtown Minneapolis. It was, my first or second year within the financial business, and I was working in the 43rd floor of the Wells Fargo Center there in Minneapolis, and we were literally watching the TV when that second plane hit, and my job there was to call a lot of folks in New York to confirm trades. And it was just a really eerie feeling to see that happen live on TV, and then quickly pick up the phone and try to get a hold of my contacts in New York, and nobody was picking up on the other end. And some of the lines wouldn't even go through. So that was a horrible day, and it's very strange to me to think how impressionable I was at that time with that mega event that kind of defines our generation to a degree. And today, a 22-year-old, somebody who is the same age that I was back then, will have no recollection whatsoever of that day. They were too small to even remember what took place. And I find that to be very interesting as well, because for a lot of us, that is a day that we will never forget. When we go to our graves, we will probably remember very few individual days out there in our lives, but 9/11 will be one of them for many of us. And it's still, to me, one of the saddest days of the year. And so with this being a bit more of a special year with the 20-year anniversary, any of you, especially out on the East Coast, that may have been affected by the horrible tragedies of that day, we're certainly thinking of you. So anyway, might be a bit of a solemn weekend there, but we'll be back next week with more trading, and we'll see how the months progress here for us. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.